Suze Orman appeared on the Today Show and talked about the best personal finance strategies for a successful retirement, and she made a surprising and extensive reference to tax-free retirement. Let's take a look at each one of her strategies, and I'll evaluate them one by one. Let's take a look at the first one.
I don't think that the key to your retirement is owning a home. I think the key to your retirement is having enough money to pay whatever your expenses happen to be. So the key is to get rid of as much expenses as you can. Don't have debt. If you do have a home, make sure that your mortgage is paid off by the time you retire. That would be my number one tip to tell everybody they have got to do if they do own a home.
Okay, so according to Suze Orman, the most important thing you can do to prepare to have a successful retirement is to pay off your home. Now, to the extent that she's advocating for making prepayments on your mortgage, I have to wholeheartedly disagree. Why? Let's say you have a mortgage of between 2 and 4%. Mathematically speaking, you're better off taking those prepayments and investing them in the stock market, where you might earn between 8 and 10%. This is particularly true if you're a good saver and have the discipline to invest those prepayments as opposed to spending them on your lifestyle. Now, I'm not saying you shouldn't eventually pay off that mortgage over the full 30 years. It's those extra payments that give me pause. Okay, not a great start to the discussion in my estimation, but let's see how things develop. Savannah Guthrie continues by asking a very important question. Let's take a listen.
Where is the best place to invest your money so that if you do have 30-ish years of retirement, you're set?
Yeah, I've said now for a long time, where you just forget the tax write-offs of your pre-tax 401k or your IRA, forget those now. And if your corporation offers it, can you do a Roth 401k or a Roth IRA, which are after-tax contributions? Why?
Okay, so this discussion takes a marked turn for the positive. It would seem that Suze Orman is all in on the tax-free paradigm. I've long warned against succumbing to the siren call of tax-deductible retirement accounts like 401ks and IRAs, particularly if you're in the 24% tax bracket or lower. You're getting the deduction at historically low tax rates only to postpone the payment of those taxes to a period in the future when tax rates could be dramatically higher than they are today. Suze's recommendation here makes a ton of sense. Now let's see what Suze's justification is for investing exclusively in these two tax-free retirement vehicles.
Because you don't have to worry what the tax brackets are going to be 20, 30, and 40 years from now. I personally think they're going to skyrocket over the years. So therefore, what you see is what you get in a Roth IRA or a Roth 401k. Again, it's pre-tax versus after-tax, but after that, it's tax-deferred versus tax-free. It's for your beneficiaries in a pre-tax account. They're going to pay total taxes on it. After tax, they get a tax-free.
Okay, so Suze makes a couple of great points. First, tax-free accounts make sense because she personally believes that tax rates are going to skyrocket in the future. Notice she didn't say rise ever so slightly. She said skyrocket. That conjures up allusions to former Comptroller General of the federal government, David Walker, who predicted that tax rates would have to double by 2030 to keep Social Security, Medicare, and Medicaid solvent. To hear Suze say this really warmed the cockles of my heart. She joins the ranks of other financial gurus like Ed Slott, Dave Ramsey, and Clark Howard, who also recommend that you forego the tax deduction today when you can most afford to pay the tax and receive your retirement income tax-free as a protection against potential higher taxes down the road. I also loved her phrasing that with Roth accounts, what you see is what you get. Contrast that with IRAs and 401ks, where what you see on your statement is most decidedly not what you get. For example, you could have $1 million in your IRA today, but unless you can accurately predict what tax rates are likely to be in the year you take that money out, you don't really know how much money you have, and it's pretty hard to plan for retirement if you don't know how much money you have. With Roth IRAs and Roth 401ks, conversely, what you see is what you get. That's the brilliance of tax-free investing. Okay, let's keep going.
Time is the most important ingredient in your retirement recipe. Let's just say you have 40 years. You're young. You have 40 years till you're going to be 70. You put $200 a month away into a Roth IRA or Roth 401k, average market returns. Do you know that you would have $1.1 million at 70, which I think should be the new retirement age? But you wait 10 years.
Well, you're talking about having a surplus of $200 when you're 30, but shouldn't you take that $200 and apply it to one of these other things like a student loan?
You need to be saving, especially in a 401k, Carson.
Okay.
Especially if they match your contribution. You put in $1, they give you 50 cents. You cannot pass that up. I don't care if you don't have any money. You can't pass up free money. But if you started putting, just let's say, $200 a month away, and you now only have 30 years left, versus 40, you'd only have like $400,000. You just blew $700,000 because you waited 10 years. It was only a $24,000 difference in those 10 years.
Yeah.
Right.
But the 10 years, the sooner you begin, the better you'll be.
Okay, there's a lot going on in this clip. Let's take these points one by one. First, Suze Orman talks about a 30-year-old saving $200 a month until age 70, at which point they'd have $1.1 million versus only $400,000 if they waited until age 40 to start investing. I get where she's going here. She's underscoring the importance of the time value of money. In short, today is always the best day to start investing, but I'm always somewhat troubled by these types of projections, particularly when we're talking about having $1 million at some point in the distant future. These comparisons always seem to lose sight of the eroding effects of inflation over time. Given the 4% rule, $1.1 million would only afford you a $44,000 annual withdrawal per year. If all you did was assume an inflation factor of 3% per year, that would be the equivalent of $13,488 in today's dollars. Even if you couple that with a robust Social Security payment, it wouldn't be enough to pay for your lifestyle in retirement. Next, I love the emphasis that Suze put on getting the 401k match. Even if you're in debt up to your eyeballs, you should not forego the free money from your employer. If you were to get a dollar-for-dollar match from your employer, that's an automatic 100% return on your investment in that first year, guaranteed. You can't beat that type of predictability with any other investment. Kudos to Suze for shutting down any conversation of foregoing that match. And the great part is, as a result of the Secure Act 2.0, you can now allocate that match to the Roth portion of your 401k. So in summary, short of the admonition for everyone to pay off their homes by retirement, regardless of the term of their mortgage or the mortgage interest rate, Suze dispenses some very solid advice in this episode. Tax rates are going to skyrocket. With Roth accounts, what you see is what you get. Contribute at least up to the match. Invest tax-free because tax rates are going to skyrocket in the future. And with Roth IRAs and Roth 401ks, what you see is what you get. And finally, move heaven and earth to put money into your Roth 401k at least up to the match. Her tax-free retirement advice in this interview is in perfect alignment with the Power of Zero worldview. And while Suze and I don't see eye to eye on the benefits of cash value life insurance, particularly when it comes to its role as a volatility buffer in retirement and its long-term care benefits, she is to be commended for her forward-thinking approach to retirement planning. Folks, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you'd like some help getting on the road to a tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally, and don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.